Realty Income Corporation, stock ticker O, the monthly dividend paying company, just released their latest quarter's earnings. So let's go ahead and start jumping into it. We can see if we scroll down, Realty Income Q2 FFO came in at $1.07, which was beat by around 2 cents, while revenue was $1.34 billion, up 31.4% year over year, and was a beat by about $130 million. So they saw beats on the top and bottom line. So this is a good sign. And if we look at how the company's performed over the past month, they're up about 12.53%, so they've really outperformed the market during this time period, especially when you consider the fact that over the past month, the S&P 500 is down around 6.5%. Now, if we look at the heat map of the S&P 500 over the past month, there's a whole lot of red. We can see some huge downward trends with technology companies, Microsoft, down by about 15.5%, Nvidia down over 20%. We have companies like Google down 16%, Amazon nearly 20%. But if we come down here and look at this real estate sector, things are starting to look pretty green. So what's going on? Well, you have to understand we have been in a high interest rate environment for the past year or so now. And what this has done is it's pushed Realty Income's share price down quite a bit. We can see there was even a time in 2023 when the share price got as low as around $46 per share. Earlier this year, the share price was as low as around $51 or $50 a share. And there were plenty of opportunities for investors to get risk-free yields of close to around 4.5 or even 5%. Now, as of right now, Realty Income is yielding around 5.32%. So a lot of investors were electing for the risk-free returns. What this did is it caused a sell-off in Realty Income and, in my opinion, created a massive opportunity. And this is actually something I was talking about in an article I wrote for Seeking Alpha just a few months ago. It created a once-in-a-lifetime valuation. And I'll explain why just a little bit later in the video. But now what we're seeing in the market is a rotation from these high growth stocks to more stable opportunities like Realty Income. It's going to be the idea of risk-adjusted returns. Now, the idea of risk-adjusted returns is actually pretty simple. It's just a calculation of the profit or potential profit from an investment that also factors in the degree of risk that must be accepted in order to achieve it. So it looks at the potential return, but it also looks at the potential risk of an investment. And if we look at market sentiment right now, the fear and greed index, we can see we're currently in extreme fear. So there's a lot of fear in the market right now. A lot of people are worried about the future. And we have to keep in mind, we were already on the verge of interest rate cuts later this year, and now we're seeing more calls for an emergency interest rate cut. So with all this news, this makes Realty Income a more attractive investment opportunity, and here's why. One of the most important things you have to understand about Realty Income, again, is going to be the risk-adjusted returns. And this is actually something they talk about in their investors presentation, and I don't see a lot of people talking about this, but this is such a key concept. If we look at this note over here, we can see historically, Realty Income delivered more return per unit of risk versus majority of S&P 500 companies and S&P 500 REITs. Here on the y-axis, we can see the total return compounded annual growth rate since 1994, and down here on the x-axis, we get beta. Now, beta is a measure of market volatility. If a company's beta is 1, it means it follows the market volatility pretty closely. If it's anything higher, it means it's going to be more volatile, and if it's anything lower, it means it's going to be less volatile. So what we can see is Realty Income not only has a very low beta, but it also has very high compounded annual growth rates since 1994. So that's a very good combination. And in this scenario on this chart, we're looking at them compared to other S&P 500 REITs. If we come over here, it gets even more impressive. We're looking at Realty Income versus members of the S&P 500. And we can see Realty Income return per unit of market risk is in the 91st percentile of all S&P 500 companies. So with fear in the markets right now, investors are going to like Realty Income a lot more. And it's not just because of the historical great returns or even the low beta, but it's because the dividend metrics for this company has been so good historically speaking. Look at the starting dividend yield right now, sitting at 5.32%, and this was as high as around 6% just a few months ago when it was trading a little bit lower. But also keep in mind, this company is a dividend aristocrat. They have over 25 years of consecutive dividend increases, and they pay out dividends every single month. So look at this dividend history every single month, consistently paying out dividends, growing those dividend payments over time. And if we look at the dividend growth rate of this company, we'll scroll down, we can see over the past 3 years, a dividend CAGR of about 4.33%, 5-year 3.55, and 10-year dividend growth rate of 3.87. Now, those aren't astoundingly high dividend growth rates, I know, but the key concept here is yes, those dividend growth rates are decent, but more importantly, they're very predictable. It's very rare that you can see a REIT continue to increase their dividend payments through the thick and thin. Think of all the times they continue to hike their dividend. Throughout 2008, throughout 2020, throughout 2022, They never cut their dividends. They continue to hike those dividend payments on a quarterly basis and pay them out every single month. So it's easy to see why people are looking for income and growing income like Realty Income. And if we look back at the earnings report, we can see Q2 earnings not only beat expectations, but they continue to reaffirm their 2024 guidance, should give investors more confidence. And if we scroll down, we can see a quote from CEO Summit Roy, supporting our stable and growing cash flow stream, our liquidity position remains strong, and our operations and portfolio of leading clients are healthy. And we can also see their portfolio occupancy rate came in at 98.8%. So if we go ahead and scroll down and look at the portfolio occupancy, since around Q1 of 2022, it's pretty steadily stayed around 98.6 on the low end and even getting as high as around 99%. So pretty good stability and consistency from their portfolio. Now, with all that being said, there still are some concerns that people have about Realty Income, and I want to point out a few of them. And the first thing is going to be shares outstanding. If we jump over to my stock screener, again, you can download any of my spreadsheets over on tickerdata.com and also get access to the Ticker Data add-on that allows you to automatically import stock financials straight into your spreadsheet. So if we come up here and plug in stock ticker O, all this data will automatically load in. Now, if we come down here and look at shares outstanding, we can see in 2013, shares outstanding is sitting at about 191 million, and in 2019, it jumped all the way up to 315 million. Now, if we look at where they ended in 2023, it was sitting at 692 million. So shareholders have been getting diluted at a very, very high rate. And a lot of investors, when they see this, get pretty concerned, but you have to understand exactly what's going on here. And I have talked about this before. When we're talking about a REIT, they are required by law to pay out 90% of their earnings in the form of dividends. So what this means is they really only have two ways that they can grow. They can either take on debt or they can issue new shares. Now, for the majority of 2010s, the interest rate was pretty low, so we can see they elected not to issue that many shares during this time period, but as interest rates have increased, we can see over the past few years, they've decided they don't want to take out high interest debt. So instead, they've been issuing new shares. And let me tell you, in the past couple of years, they have issued a lot of shares. Again, look at 2020, 345 million, all the way up to 692 million. That is a very big deal. So I know shareholders aren't excited about seeing their shares get diluted, but in all reality, this is probably the best move for Realty Income right now. In order for them to be able to hit their target FFO growth, this is probably the best path. Now, in other news, a huge concern for a lot of investors is some of the largest tenants for Realty Income aren't looking too good right now, and namely, if we scroll down, we can see Walgreens, Dollar General, and Dollar Tree are all having some problems. If we look at the investor's presentation, we can see these are the largest tenants for Realty Income. Dollar General around 3.8, Walgreens around 3.8, and then Dollar Tree / Family Dollar at about 3.3%. So close to around 10% of their entire portfolio is with these three tenants. And if you've been keeping up with these companies, they have been struggling over the past year or so. For example, Walgreens recently announced they're going to be closing some of their US stores. If we scroll down on this article, we can also see Dollar Tree / Family Dollar. They're planning to close 1,000 stores in the near term. And then Dollar General has had some problems as well, but not nearly to the degree of the other two companies that I just mentioned. They don't have nearly as much competition. So yes, those concerns are justified, but here's what you need to understand. Realty Income still has a very good occupancy rate and a very good credit rating. If we come down here, we can see the average credit rating of Realty Income versus other REITs within the S&P 500. And immediately we can see Realty Income is right there near the very top. So I completely understand some of the concerns with Realty Income's tenants, but I promise you, the credit rating agencies know a lot more than me and you about the strength of Realty Income's tenants. So as long as our credit rating stays within this range, it isn't really something I'm too concerned about. So the question we need to answer now is yes, Realty Income, trading at $59.18 is still down close to around 2% in the past year, but after this jump up in the past month, they're up around 12.53%. Are they still trading at a good value? So to answer that question, let's go ahead and jump into my REIT valuation spreadsheet. We'll come up here and plug in stock ticker O and hit enter, and all this data will load in. Now, at a quick glance, if you come over here and look at the dividend data, you can see payout ratio is saying 242%. Now, why is this? This is a company that's been paying out dividends for over 25 consecutive years. Well, again, we have to keep in mind we are looking at a real estate investment trust, so the payout ratio is not actually what we want to be looking at. It's going to be the AFFO payout ratio. If we jump back over to Seeking Alpha and click on Dividend Safety and scroll down, we can see the AFFO payout ratio right here, forward-looking, sitting at 74.74%. This is a healthy range for a REIT, so it's actually not something you have to be concerned about. So let's go ahead and jump into our first valuation, and that's going to be the AFFO multiples valuation. If we go ahead and zoom in, basically what we're doing is we're valuing Realty Income by looking at these comparable companies, looking at their price to AFFO multiple, and seeing what the difference is with Realty Income. So for example, Realty Income's price to AFFO right now sitting at about 14.19, and if we look at these comparable companies, they have an average price to AFFO of 17.61. So compared to their peers, it looks like Realty Income is a little bit undervalued. If we applied the same price to AFFO, Realty Income's intrinsic value would be about $73.47. So that's pretty interesting. Now, the next valuation that we're going to look at is going to be the historical price to FFO valuation. And I really like this valuation because it values the company compared to how they are right now, compared to how they've traded at historically in the past. So what we do is we take the historical price per share and also look at the historical FFO per share to find the historical price to FFO. And we can see this for every single year charted out right here. And historically speaking, on average over the last 10 years, Realty Income's average price to FFO is sitting at 18.10, but if we look at what it is right now, it's sitting at 14.91, so it's significantly cheaper than it has been on average over the last 10 years. We can see 2023 is the lowest it's been, sitting at about 14.52, so it's a little bit higher than it was then, but overall, still significantly lower than the average over the last 10 years. Now, finally, if we look at the dividend discount model, and the idea behind the dividend discount model is we should be able to value stock based on how much they're paying out in dividends and how much that dividend is increasing over time. And like we already know, steady track record of paying out dividends and growing those dividend payments. So in this scenario, I'm projecting a dividend growth rate of 3.25% and a discount rate of 8.5%. This gives us a dividend discount model price per share of $62.15. So when we jump over to the output tab, we can see the two valuations we used, AFFO multiples at 73.4 and dividend discount model 62.15. Now what you will notice is the price to FFO model is not here because it doesn't give us a specific price per share, but we did come to the conclusion that it looks like it's undervalued, just like these other two valuation models are telling us. So we come to an intrinsic value of $67.81. So with a 10% margin of safety, this company is actually still within the acceptable buy range, sitting at about $61.03, with a 20% margin of safety, the acceptable buy price sitting at about $54.25. And keep in mind, it was not that long ago at all that the company was trading within that range. If we look at just the past 6 months alone, plenty of opportunities to buy within that 20% margin of safety range. Again, this is something I was talking about on YouTube a few months ago. I wrote an article on Seeking Alpha about it. And I also talked about it in my free weekly newsletter, which you can sign up for at the link in the description. So Realty Income is by no means a perfect REIT. There's a couple of concerns people have about it moving forward, but the history is very impressive. It looks like it's still trading at a pretty decent valuation, and with current market conditions, I think investors are going to start liking Realty Income quite a bit more. So go ahead and let me know what you think of Realty Income in the comments down below. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.